We are here right now with Tony Hall. We're looking at gold futures lower. Our next guest says, get used to that pattern. He's from Duet Asset Management right beside me. Tony, thanks so much. We know you are the CIO for the best performing fund there at Duet. So mostly you're watching gold, you're watching oil.
Yes.
Back in September, 2,200 an ounce, 2,200 an ounce, you said, by the end of this year. And now you're saying, okay, hang on, I have to change my mind. What's going on?
Well, I think that's what we do. I mean, when the world changes, we have to change quickly. And with what we're seeing at the moment, and I think there's conflicting factors with gold. I mean, people think of it as a safe haven, store of value, and with what's going on in Europe and throughout the world with a lot of the liquidity crisis that I think is going to happen. People are going to put their money back.
I'm just curious, and I wanted to ask you about the rationale because, I mean, we just went over Italian yields, Spanish yields. I know that a lot of traders are paying attention to those records this morning, that euro area high. So it's not as if the volatility has gone away. It's not as if the instability has gone away. What's making you change your view? Is it just a crowded trade?
It's not so much a crowded trade. I think in commodities you have risk-taking assets, you risk aversion or risk assets like gold, the silvers. Now people are putting their money back to cash, and I think that pretty much tells you.
So you feel like even now gold looks riskier than cash?
I think so. I think people have got this year to the stage where they're putting their money back to cash rather than thinking, am I going to put it in the Swiss or Swiss franc or gold, etc. No, I'm not. I'm going to put it back to cash and play safe.
Tony, as you mentioned, I mean, you're paid essentially to make decisions based on the feedback you're getting from the market, so it's good to say you change your mind. That's your job.
Yep.
So if you were at $2,200 an ounce for this year for gold by the end of this year, now you're saying that's not going to be the case. Where do you think gold is heading? What's your new target for the end of this year?
In terms of the end of this year, I mean, I think we're going to be, $150, $200 lower than we are currently. My long-term trend has not changed. I do think gold will go higher eventually. I'm just saying, as a short-term move, I think we might see lower before we see the trend continue higher.
Okay, so you think essentially there's going to be a correction, if I'm hearing you correctly. And just how dramatic is it going to be, let's just say, in the next 4 to 6 months?
I think it's going to catch people by surprise, because if you go to the stage where you think the world's not doing very well, we get further, I guess, events in Europe that are going to make you feel like we should go into gold. It's probably going to go up as a knee-jerk reaction, but unfortunately I think afterwards people are just going to go back to cash and it's going to go lower.
Okay. Tony Hall still with me here from Duet Commodities. Glad you are on this side of the Atlantic. It's a rare and good occurrence. Tony, I want to play some sound because we've been talking with a lot of our guests these past few weeks about gold. It's a big subject. We had Jim Rickards on with us last week, and I just want to let the viewers give a little reminder to what he told us.
If you include the U.S., ECB, and China using M2 with 100% backing, which I don't recommend, but if you did that, it's $44,000 an ounce.
That's good.
Yeah, that
sounds about right. That was the number you're going to say?
So just to be clear, I'm not predicting $44,000 gold. What I'm saying is this is 8th grade math. These are not pie in the sky numbers.
Yeah. So, okay, you just heard Jim Rickards say he's not saying that gold is going to go to $44,000 an ounce, but he's saying if you just do this basic math calculation, right, $1 for every bit of gold that is in a vault, that's what you get. I mean, what is the price? I know you think we're going to come down a little bit, but towards the end of next year, because I did hear you say the trend still goes up in your view, just not right now.
No, absolutely. I mean, with us, I mean, we have to obviously look at the 3 to 6 month view as well as the long term. Long term, I think the trend's still in place. Obviously, I don't think it will be obviously that high anytime soon, but around 2,000 to 2,500 range is definitely something that people are focusing on, and we think we can get to in the next 12 months. The next 3 months are going to be dominated though by, you're talking about Europe and problems here. We've gone through that and gold's gone down. So if it can't rally during periods like that, you're going to see what forces are really moving.
Although what about something being a tired trade, Tony? I mean, we've been talking about Europe now for, it feels like almost a year. Experts tell us we're going to be talking about it for the next year. So, I mean, there are just natural sort of periods, right, in the market where people come in and out.
Yeah, I don't think the problems are going to be going away in Europe, but I think that once things are okay, then the spotlight will go elsewhere. It'll probably come to the US. But on OECD nations at the moment, having a hard time. And that's what makes you want to go long gold from a safe haven point of view. But from what I'm seeing in the flows and its inability to rally, given what's happened, I think that tells you a lot.
Tony, I want to bring in some comments from Jim Grant. He was on with us as last week as well, speaking about gold and just talking about the psychology behind it. Mm-hmm. Here's what he had to say.
Gold is a kind of poetry, but I think more tangibly and perhaps more meaningfully, I value it as kind of conceptually as one divided by N, where N equals the world's faith in the judgment and the wisdom of people like Ben Bernanke.
So, I mean, you can extrapolate, obviously, from Jim Grant that the world is not holding too much confidence in central bankers, that in his view, they're all been too loose and are allowing money to flow a little bit too freely. Still, obviously, that factors into your calculation for gold. What about oil, though? Because I know in the short term, as much as you are bearish on gold just at the moment, longer term, you're pretty bullish on oil.
Yeah, absolutely. I mean, completely different drivers. I mean, gold is not really a fundamentally driven commodity. It's about fear, it's about safe haven. With oil, it is about supply and demand, and supply currently, and particularly in Brent and light sweet crudes and products, we're at 8-year lows, so things look very constructive. So I do think that we are going to see a further supply shock and higher prices.
Just how high?
I think we're going to $150 in the next 3 to 6 months.
And is any of that based on some of these headlines? I mean, I'm looking at our own editorial line today on oil declining as Italy's borrowing costs are rising again to this euro area record. I mean, part of it, you have the fundamentals, and then part of it is a sentiment call.
Yeah, sure. I mean, in terms of the macroeconomics, I mean, it does affect commodities. I mean, the supply and demand is the underlying driver, but the macro will give it the headwind or the tailwind kind of it needs. But I don't need demand to be fantastic. I need it to be okay. This is going to be a supply-led rally. It's not going to be a demand-led rally like in 2007. But it will get to the stage where it causes demand destruction. We are not seeing demand destruction at $110, $115 a barrel.
I have to ask you, Tony, because, you know, we complain in the U.S. about how much we pay to fill up, and I know we shouldn't, and I know I shouldn't even do this with an Englishman because I know you pay at least 4 times what we pay. How do you see gas fitting in this year, if at all? Is it going to follow what oil is doing?
Well, this is quite good timing. I mean, today we've seen a big move lower in gasoline, and obviously there's been a lot of liquidation actually in the last 24, 48 hours. Personally, I think gasoline is actually a good long trade to play for next year. I don't think that a lot of the refineries are going to be around next year, and in particularly in PAD 1 in the New York region, you're going to find there's going to be less product around.
All right, so we've got to get out our bikes and our rollerblades, Tony.
Yes.
Thanks very much, Tony Hall, joining us here on this side of the water from Duet Asset Management. He is the CIO for the top performing Duet Commodities Fund.